Hi everyone, August Biniaz with Real Estate Investing Demystified. We're here in Las Vegas at the Multifamily Wealth Conference Project, and we're with our good friend Goossens. Hey man, how you doing? Nice to see you. Yeah, absolutely. Cross-border, Canadian, Australian. For sure. I remember you reaching us out a while ago because you're focused on helping, international investors, but I think your majority of your focus now is more U.S.-based investors. It's just a bigger market, 330 million people. Why bother with international investors? And we've spoken about this many times.
Yeah, no, it's a great niche in the beginning, like you guys found when you do with Canadian investors. It's a great way to get you into the game. But as you slowly progress and you get more deals under your belt, you realize that there's so much money here in the US. It's like, let's just focus here and not worry about exchange rates and all that other stuff.
Exactly. All the hurdles we have to go through, we're realizing that as well. We have the infrastructure set up, so we're still going to service our Canadian investors. But talk to us about this event. You're speaking. I see it 200 times.
I don't even know yet, but I'm just being thrown on stage and talking about probably about the distress in the market, what we're seeing in the last 12 months with interest rates rising, how we as operators navigating this, and then what's coming down the future. I think I feel a lot of people talk about blood in the water, some distressed assets coming. But we're still active buying. We just closed on a deal last month.
Yeah, I was just talking about that. We closed on a deal within this market.
Right.
And it looked like a great deal. I was looking at it. It was a smaller deal.
88 units in Tempe, Arizona. But we picked it up at a true 5.5 cap, where probably 12 months ago you would have picked that up at a 4 cap. So cap rates have really expanded, about 150 basis points. And we got the debt at a 5 interest rate. So we're coming with true positive arbitrage for your listeners, meaning that we've got true cash flow from day one, and that's really, really important because you want to protect your downside. So with the crazy interest rates rising, you don't want to have that risk on the table. So we chose fixed rate, 5% interest, and our going-in cap rate is higher than that, which means cash flow from day one, which has been very uncommon. I don't think we would have seen that for at least 5 years. A lot of value add, you come in, your cap rate going is probably less than your interest rate. You're trying to add that value, bring that cap rate up, and then go on in cash flow. But times have changed, so I think buying in today's market is really, really important if you can stay to those sort of fundamentals.
Absolutely, I think closing on a deal in this market really, they say that easy times make, how does it go? Easy times make tough men, or
easy men,
and
easy
tough times
make tough times.
Exactly. So now closing on a deal in this environment, I mean that must have been a method of a task. So how was the debt market? How was the equity environment going to investors? Talk to us about any difficulties you faced.
So I've done 22 syndications to date in the last 8 years. I have had to continue raising post-close on this deal, and this is my first deal. First deal they've had to do that.
You have to keep raising after you close on a deal.
That's just the indication of where equity is right now. A lot of people are scared, seeing the headlines, SVB, and we could close. We raised enough money to close on the deal. Now we're just raising for the CapEx. I think we'll be closed, finish raising within the next week. So equity's been a bit of a challenge. We've had about a 40% drop-off rate in our investors. So we go out to the market, people are interested. Typically, we see a 15 to 20% drop-off rate. That doubled. So people are scared and they're holding their chips back from the table. In terms of debt, 100% agency all the way. No more high-octane debt funds. Floating interest rate. It's fixed for us. We can tell that to investors, saying you don't have any risk of interest rate movement over the next 5 years. People love that. So for going forward for the next 6 to 12 months, we're just doing only Freddie or agency execution on buyers.
Let's chat a bit about asset management. This is to execute the business plan. Obviously, this is a value add deal that you're working on. What are you seeing in the environment when it comes to value add? Do you hire a third party, like a property manager? Do you do your value add? Do you guys do it in-house? And have you seen any decrease in price for material, labor? Talk to us about asset management.
A couple of things. So we do third-party property management, but we do all the construction management in-house and all the asset management in-house. We have seen a little bit just coming out. We're here in April, so we just come through the winter season, but a slower season, and add the interest rate debacle on top of that, add SVB on top of that. We've seen a bit of a flattening out of rents, but we're really focused more on the lease trade out now. So looking at our rent roll, seeing where those lower rents are, and focusing on those folks to say, hey, do you want to move into our renovated unit, or is your lease up? Here's where I think the market will be. And we're still getting very good lease trade out, 15 to 20%. It just, you're not seeing that you might have seen a $1,700 two-bedroom. That's probably trading at like a $1,550, $1,600 a day, where a year ago that would have been $1,700. A one-bedroom renovated might be $1,350, $1,400. A year ago it might have been $1,500, $1,600. So we're seeing it back off just a little bit, but it's not plummeting, right? Because people got to live somewhere, and the fundamentals of real estate is still there.
Yes.
In terms of costs, we have seen payroll go up on site. So
you have
typically, 8-9 years ago when I got started, $1,100 a unit, $1,200 a unit. That's now $1,600, $1,700 a unit, depending on where you are.
Wow.
Insurance has gone up. I know you guys are investing heavily in Florida.
Yes.
And that's gone bananas.
Yes.
Right. So those are the two things: payroll, insurance, and taxes. Add taxes onto that. Really trying to cover those things or keep them in check as we progress forward, as good asset managers, as good stewards of people's capital. So.
Amazing. Now, I want to also talk about what you've been through over the last few months, kind of purchasing an asset in an increasing interest rate environment, which is very difficult because we're still in the Fed's fundraise rate being increased to fight inflation. Talk to us about your prediction. Where do you see the market going? A lot of talk from some experts is sit on the sideline. Smart money is sitting on the sideline, like yourself. You're perfect example of if the deal makes sense, the numbers make sense, and you can get long-term debt on it, fixed rate. Why not? And you're making that arbitrage between the going-in cap and your interest rate, which it's just a no-brainer.
Yep.
What is your thesis on where the market is heading? Where is the debt environment heading? And should newer syndicators see this as an opportunistic time to enter the market? Should they sit on the sideline? What is your advice, having been through what you've been through?
Yeah, so I think institutional capital, some is sitting on the sideline. If you look at the headlines, like I think Blackstone or BlackRock just raised $30 billion for a real estate
largest real estate fund in history.
Right. So, but what we are on this show are opportunistic, right? I don't have to go through investment committee. I've got me and my business partner and my chief investment officer. We make a decision and we're nimble and we can go quickly. So we're still underwriting a ton of deals.
And the size of deals. You're not looking at the deals they're looking at. Any units they wouldn't have touched it.
Right. We're between $20 and $35 million acquisition price. We try to do 3 to 4, 5 deals a year. So we're not even trying to touch the institutional quality assets. We will eventually one day. But back to your question, where I think the market is going, May 3rd is, I think, the next Fed meeting. We're all like watching with bated breath. I think at this point, you go back to NMHC at the beginning of the year, everyone thought beginning of the end. SVB happened. Everyone was like, I'm not going to swear on this, but OSHIT. These are the cracks that are starting to form in the foundations of the US economy. I think it's being contained. It's not a contagion effect. And now it's a waiting game to see how long can the Fed call chicken on their own, because they're going to pay debt on their own.
$30 trillion.
Right. So they're printing a lot of money, as have the rest of the world. You're starting to see other economic indicators come in saying that we think it's going to drop off soon, but no one has a crystal ball. So I think right now it's be nimble, if you can, continue to underwrite deals, and make sure. And I think it's a great opportunity because cap rates have expanded so quickly to pick up a good deal that in maybe 2 or 3 years' time, interest rates will go back down, maybe not back down to 0, but they might go back down to 3 or 4%, and you're picking up at a 5.5 or a 5 3/4. That's great. So I think for those newer syndicators out there, getting into the market today is really important, and not necessarily getting into the market. Underwrite deals, continue to stick to your guns, continue to turn over rocks, and you'll try to find something.
On that point, as far as deals, last question for you. What are you seeing with deal flow? Are you seeing a lot of deals are not coming to the market because a lot of people have long-term agency debt? Why bother bring your deal to the market? If you don't need to sell it, why sell it? You're sitting there making cash flowing on your deals. What are you seeing with deal flow?
Well, look, the bell of the ball in terms of debt over the last 5 years has been debt funds. Floating rate, high octane, high leverage debt funds. Everyone's done it. I've got deals like I've done that. And if you've initiated a deal back pre-COVID, 2019, 2020, you're coming due this year. So you're going to have people who are like, I don't want to refinance into a 7 interest rate environment. I might have to sell. So you're starting to see there was a big drop off. I think 77% of multifamily sales in the US last year didn't occur. But you're slowly starting to see deals starting to come back to market.
Oh, really? Already?
And keep talking to your broker. Don't stop talking to your broker, because these are the times where you're going to have deals to be done. So stick to your guns. I'm still underwriting and I'm still trying to close on deals.
All right, man. Awesome. Any markets that you're bullish on aside from Phoenix?
Look, Phoenix has been beaten up a little bit in the market, in the headlines. We have seen softening rents. I've only got 2 assets there, or 3 assets there now. I'm still very bullish on Central Texas, but it's the high interest rate environment, so the high tax rate environment, high insurance, not as much. I love South Carolina from a tax abatement point of view, so we're trying to buy more deals over there, and we're about to launch a ground-up construction build-for-rent deal in Central Texas. So trying to be a little bit different. A few things we're coming to market with, but just trying to be active as well.
Awesome.
So,
amazing. Let our viewers know how to get in touch with you. And
yeah, easiest way, go to reedgoossens.com. That's REEDGOOSSENS. If you're ever coming through Los Angeles, you can hit me up at info@reedgoossens.com. We can always head up for a beer, talk shop. I love meeting about and talking about real estate.
Awesome. I'm going to take you up on that.
Yeah,
myself.
Mate. Awesome. Right. Let's go get a beer.